Imagine waking up one morning and realizing your life savings have been taken not by a burglar, not by a hacker, but by the very system you trusted to protect it, quietly, legally, and with a smile. This is the story of how banks have been siphoning wealth for centuries, and why the next phase of the plan may already be in motion. Welcome to Hidden Finance, where we pull back the curtain on the stories money doesn't want you to hear. Today, we're traveling through history's banking crises, secret laws, quiet devaluations, and digital experiments to answer one question. How did the banks keep winning, even when they were wrong? And what exactly is the new trick being prepared for the future? Stay to the end because understanding this pattern might be the most profitable or the most protective financial decision you ever make. To understand how banks steal wealth, you have to start with a harsh truth. The modern banking system was never designed to be neutral. From the beginning, it was built on a trade-off, your safety and convenience in exchange for their control over your money. In 17th and 18th century Europe, goldsmiths and early bankers realized something powerful. Not everyone would come to withdraw their gold at the same time, so they began issuing more paper receipts than there was metal in the vault, effectively creating money out of thin air and collecting interest on it. When times were good, they called it innovation. When times were bad, they called it a panic, and ordinary people paid the price. Fast forward to the 19th century, banking panics became almost a regular event, especially in places like the United States and Britain. In the Panic of 1873, the Panic of 1893, and later the Panic of 1907, the pattern was cruelly familiar. Banks extended credit aggressively in good times, made handsome profits, then collapsed when confidence cracked. Depositors lined up in the streets only to discover something devastating. The money they thought was safely stored was already gone. The Panic of 1907 was so severe it nearly destroyed the American financial system. Stocks crashed, credit markets froze, and ordinary workers lost wages and savings they would never see again. Out of this chaos came the argument that would define the 20th century. We need a central bank to keep this from happening. In 1913, the Federal Reserve was born, joining institutions like the Bank of England and others around the world. It was introduced as a safety net, but also as something else, a powerful new partner for big banks, able to rewrite the rules of money itself. That partnership was truly tested in the early 1930s. The Great Depression shattered economies worldwide, and in the United States alone, more than 9,000 banks failed. Families lost their deposits overnight. With no insurance and no compensation, their savings simply evaporated into the balance sheets of failed institutions. To restore confidence, governments created deposit insurance and stricter regulations, which genuinely did help calm the chaos. But at the same time, a quieter, more controversial move was underway. One of the most dramatic legal siphonings of wealth in modern history. In 1933, as American banks teetered on the edge, President Franklin Roosevelt made a stunning announcement. Private ownership of most gold was outlawed. Citizens were ordered to hand their gold to the government at a fixed price of $20.67 per ounce. Failing to comply wasn't just discouraged, it was criminal. Just months later, the official price of gold was raised to $35 per ounce. That single stroke effectively transferred billions in purchasing power from citizens to the government and banking system, an elegant, legal, silent confiscation. This kind of maneuver revealed something critical about how wealth could be stolen without ever touching your wallet. You didn't need a banker to take your coins. You just had to change the rules of the game, the value of money itself. In the decades after World War II, many countries turned to a more subtle version of this. They used a technique economists call financial repression, but ordinary savers knew it by a different name, watching their money slowly die. Here's how it worked. Governments, buried in war debt, kept interest rates artificially low while allowing moderate inflation. On paper, savers got safe returns in their bank accounts and government bonds. In reality, inflation was quietly eroding the purchasing power of their money faster than the interest could rebuild it. Year after year, a dollar saved bought a little less, until entire generations realized their careful thrift had been partially sacrificed to protect the financial system. Then came 1971, a turning point that reshaped every bank account and every paycheck on Earth. Under the post-war Bretton Woods system, major currencies were tied indirectly to gold, anchoring governments to some measure of discipline. When President Richard Nixon closed the gold window and ended the dollar's convertibility to gold, that anchor was cut. Money became pure fiat, backed not by metal, but by trust, law, and the promise of central banks. From that moment, the ability to create money, and therefore to dilute existing savings, expanded dramatically. Look at the numbers and the story becomes brutally clear. In the early 1970s, a single average income could buy a home, support a family, and still leave room for savings. Decades of inflation, rising asset prices, and declining purchasing power of wages have changed the equation entirely. The house that cost 3 times an annual salary now might cost 8 or 10 times that. Savers who held cash or simple deposits saw their real wealth drain away, while those closest to the financial system, large borrowers and asset owners, rode the wave up. As the 1980s and 1990s unfolded, another shift tilted the table even further. Banking deregulation blurred the lines between traditional banks and risk-taking investment houses. Institutions that once mostly held deposits and made simple loans were now speculating in complex derivatives, exotic securities, and global markets. When these baits went wrong, as in the US savings and loan crisis, taxpayers and depositors ultimately bore much of the cost through bailouts, lost jobs, and weakened economies. Profits were private, but losses had a way of becoming public. That pattern exploded on a global scale in 2008. Major banks packaged risky mortgages into complex securities, sold them around the world, and used mountains of borrowed money to amplify their gains. When the underlying loans started to fail, the entire structure collapsed, triggering the worst financial crisis since the Great Depression. Markets plunged, millions lost their homes. Trillions in wealth vanished on paper, and yet, in the end, the institutions most responsible were rescued. While ordinary families were told to tighten their belts, governments and central banks did whatever it took to prevent total collapse. Interest rates were slashed to near zero. Vast quantities of money were created digitally and funneled into the system through programs with technical names like quantitative easing. Banks were stabilized. Markets eventually recovered. Asset prices soared to new heights. But savers, retirees, and cautious households holding cash deposits discovered a cruel twist. Safe now meant stagnant. When interest rates hover near zero while the cost of living rises, the math is simple and unforgiving. Your bank balance might not shrink in numbers, but its power silently erodes with every year. Those who own stocks, real estate, or financial assets enjoyed a remarkable rebound. Those who trusted banks to simply keep their money safe fell behind. Again, this wasn't a backroom robbery. It was a systemic transfer, from the passive saver to the leveraged participant, from the cautious many to the aggressive few. On top of this, banks perfected a different kind of wealth extraction, death by 1,000 cuts. Overdraft charges, maintenance fees, ATM surcharges, foreign transaction fees, penalty interest rates. Each fee seemed small, almost trivial, but together they generated billions in revenue, often from those who could least afford it. The poorest customers, with the least buffer, frequently paid the highest effective costs. The system once sold as a service began to look, for many, like a toll booth. After the 2008 crisis, public anger boiled over. Politicians around the world promised no more taxpayer-funded bailouts. No more too big to fail. Behind the scenes, a new architecture of rules emerged, one designed to make banks safer, but with a catch almost no one outside the legal and financial world truly understood. The age of the bail-in had begun. A bailout uses public money to rescue a failing bank. A bail-in, by contrast, uses the bank's own creditors and large depositors to absorb the loss. In simple language, if the bank fails, part of your large, uninsured deposit can be legally converted into the bank's shares or simply written down to plug the hole. For small depositors under insured limits, nothing may change. But for businesses, savers with larger balances, and people who assume money in the bank is untouchable, the risk is real. In 2013, the world saw a preview of how this might look. On the small island nation of Cyprus, banks overloaded with bad debts were on the brink of collapse. Instead of a traditional bailout, authorities imposed losses directly on large depositors. Some people woke up to find a significant portion of their savings gone, converted or confiscated to stabilize the banking system. It was a shock, a warning, and a demonstration under the new rules. Deposits are not just savings. They are part of the bank's safety cushion. The message was subtle but powerful. In the next crisis, you may be the backstop. And that brings us to today and to the new trick being tested, debated, and quietly prepared. Across the world, central banks and governments are exploring a profound shift, the move toward a mostly cashless society, and potentially central bank digital currencies, CBDCs. On the surface, the benefits sound compelling: faster payments, lower transaction costs, better financial inclusion, and tools to fight fraud and crime. But beneath the glossy pitch lies a set of possibilities that could redefine how wealth is controlled, moved, and taken. In a fully digital monetary system, every transaction leaves a trace. Your income, your spending habits, where you donate, what you buy on weekends, all of it can be recorded, analyzed, and in some regimes, potentially controlled. Now add CBDCs to the picture, digital money issued directly by central banks, potentially programmable. Programmable in this context means the money itself can carry rules about where it can be spent, when it must be spent, even how fast its value decays. Imagine a world where, during a recession, authorities decide to stimulate the economy by issuing digital money that expires if you don't spend it within 6 months. Or where interest rates go negative, meaning your account gradually shrinks if you try to hoard cash, and with no physical banknotes left, there's no escape route. Or imagine differentiated rules, one set of conditions for ordinary citizens, another for large institutions with access to special forms of digital reserves. In such a system, the line between stability policy and forced redistribution becomes very thin. The same tools that can fight crisis can also quietly transfer wealth from savers to borrowers, from individuals to institutions, with precision like never before. Commercial banks are watching this evolution closely. Some fear disintermediation, the risk that people might move deposits directly into central bank digital wallets, bypassing traditional banks. Others see opportunity, new ways to collect data, new fee structures, new products built on top of digital rails that they help manage. Combine this with the ongoing decline of cash, the rise of contactless payments, and the normalization of constant surveillance in the name of convenience, and you start to see the outline of the new trick. Not a single dramatic seizure, but a system where opting out becomes almost impossible. This doesn't mean every CBDC project is malicious or that every banker is plotting your ruin. Most policymakers genuinely argue they are trying to make the system more efficient and more inclusive. But history teaches a hard lesson: when powerful tools exist, they are eventually used, especially in times of panic. The same central bank that promises restraint in 2025 may face pressures in 2035 that lead to aggressive policies, rapid devaluations, or punitive controls on saving and movement of money. And as always, those closest to the levers of power and finance will be best positioned to benefit. So what can we actually learn from this long story of banks, crises, and ever-evolving tricks? First, that safety in finance is never absolute. It's always conditional on rules that can change. Gold confiscation, devaluation, inflation, zero interest rates, bailouts, bail-ins, and now digital programmability. all are different faces of the same truth. Control over money is control over wealth. Second, that passive trust has a cost. Those who never question the system often discover, too late, that the system has quietly been rewriting their future. In the end, this isn't a call to bury gold in your backyard or live in fear of every policy announcement. It's a call to awareness, to understand that your bank balance is not just a number, but a relationship of trust, law, and power. Diversifying where you hold wealth, learning how money is created, staying informed about legal changes to deposit protections and digital currencies. These are no longer luxuries for financial nerds. They are basic survival skills in a world where the rules of money can change overnight. Banks have stolen wealth in the past through crisis, inflation, and quiet manipulation of the rules. And the new trick they're planning now is to move money into a world where control is total, digital, and programmable. Whether that future becomes a tool for prosperity or a new form of silent confiscation depends, in the end, on how many of us truly understand it. You've been watching Hidden Finance, where we decode the past to expose the systems shaping your financial future. If you found this revealing, share it with someone who still believes money in the bank is the end of the story, not the beginning. Until next time, this is Hidden Finance, reminding you, don't just follow the money, learn who's writing the rules behind it.